Most people think the UK property market has followed a single trend. Prices go up and then down, the market booms and then it slows down. But when you look at millions of property transactions over the last 25 years, a very different picture emerges. The market hasn't simply become more expensive, it's actually splitting into two different worlds. So today we'll look at two advanced visualisations built from the UK property transaction data to see how the structure of the market has changed since 2000. What you'll see helps explain why first-time buyers, investors and homeowners often feel like they're living in completely different housing markets. So with graph 1, this is what's known as a density contour plot. The horizontal axis shows time from the year 2000 to 2025 and the vertical axis shows property prices. The darker the blue, the more the transactions occurred in that area. So instead of looking at average prices, we're looking at where most of the market actually lived. And immediately something stands out. So you can see back in the early 2000s, the centre of gravity of the market was concentrated around the 100,000 mark. That's where huge numbers of transactions were taking place. By the mid-2000s, that cluster had moved close to £150,000. Then after the financial crisis, we see a period of stabilisation. The market didn't completely collapse, but instead it spent several years consolidating. Then from around 2013 onwards, something changes. The entire concentration of activity begins shifting upwards again. The densest area of the chart steadily climbs. By the early 2020s, the market's centre of gravity is sitting much closer to the £200,000 to £300,000 range. What's particularly interesting is that the lower price areas become less dominant. Properties below £100,000 don't disappear completely, but they represent a much smaller share of the market than they once did. And at the same time, the upper regions of the chart expand dramatically. We start seeing meaningful transaction activity at price levels that were once relatively rare. The market isn't just becoming more expensive, it's stretching. And that's a crucial distinction. But price movement only tells part of the story. To really understand what's happening, we need to look at how the comparison of transactions has changed. So graph 2 is a stream graph. This section visualisation shows the market in a completely different way. Each colour band represents a different price range. The thickness of each band represents the number of transactions occurring within that price bracket. So instead of focusing on price levels, we're focusing on market composition. And the pattern is very interesting because in the early years, lower priced properties dominate. The market is heavily concentrated in the more affordable bands, and that makes sense. Property prices were lower, wages had greater purchasing power, and a larger proportion of transactions occurred at the bottom end of the market. But as we move through time, those lower bands gradually shrink. Meanwhile, the middle bands begin expanding. Properties between £100,000 and £300,000 become the more dominant force in the market. And then something even more significant happens. The higher value bands start growing rapidly. Properties above £500,000 become increasingly important. The luxury segment becomes far more visible. And by the 2020s, the market looks fundamentally different from the one we started with. And this simply isn't just inflation, it's a structural change. The market has effectively shifted upward through the price spectrum. So when you combine both visualizations, the picture becomes much clearer. The density chart shows where the transactions are concentrated. The stream graph shows how the transaction composition changes. Together they tell the same story. The affordable end of the market has been shrinking. The middle of the market has expanded dramatically, and the higher end value segments have become increasingly important. So in other words, the UK property market is no longer moving as a single unit. Different segments are behaving differently. A buyer looking for a starter home is experiencing a completely different market from someone buying a premium property. And investors focusing on affordable housing are often seeing very different conditions compared with investors targeting higher end assets. So what this means for investors is that averages can be misleading. And when headlines talk about national house prices, they combine all of these segments together. The reality is that the opportunity often exists within specific parts of the market. Understanding where transaction activity is concentrated can reveal far more than simply looking at average prices. It helps identify where demand is the strongest, where liquidity exists, and where the market is evolving. The biggest takeaway from this data is simple. The UK property market hasn't just become more expensive, it's changed shape. And once you see that shift, it's difficult to look at the housing data in the same way again. If you enjoy this type of data-driven property analysis, please subscribe. In the next video, we'll look at where property activity is actually concentrated across the UK and uncover some of the country's hidden property hotspots.